Saturday, July 23rd, 11:46 a.m. New York time. This is a review of my past week's day trading with options on the S&P 500. These are options that expire the same day. They're referred to as zero DTE. And these are credit spreads that collect income. First, do a little review on the market itself as a whole, the S&P 500, and then we'll go into the day trades. The S&P 500, which is the day trading instrument I use. On the monthly time frame, each of these candles is a month. The current one not being done yet, and this is over 5 years. You see the low of the 5 years, the high of the 5 years. The current trend is up. For the year, we're at the new high for the year, coming into the high of the prior year. So again, the momentum, the trend is up on the higher time frame, the monthly candles. And here, it's a supply zone of sellers in the past. That's what we're coming into. Take it down to the faster time frame, the weekly now. Each candle's a week. So we just completed last week. This is the candle last week. Big wick on the top, till, shadow. Yep. On top of a trend. In this red area, which is the supply zone, prior sellers all the way back there. Big candle here, midpoint labeled. This big consolidation here, and that big impulse move up. What I'm getting at here, let's take it to the faster time frame now, down to the daily. Friday closes an inside candle. Inside candle, I label as yellow. And because it's a solid candle, equivalent to a red, inside candle means indecision. The market did not know for what direction to go. It didn't go above or below the prior trading candle range. Indecision. The prior day was a red candle. And prior to that was the new high of the year, is a dodgy candle on top of a trend. Overall here, you can see it's an acceleration. So what I'm showing you here on these multiple time frames is what's leaning towards more bearish bias, not meaning that we're not going to continue going higher. We might go in acceleration, might do a minor retracement. Well, minor retracement, be aware on the bottom, big round number, 4,500, and a gap here that hasn't got filled yet. Some setups I'm looking for my higher time frame, meaning my swing trading. But those are different videos. We'll go in here, focus on day trading. Looking here on the 15 minutes, 5 days, Monday, all the way through Friday. The yellow horizontal lines or the strikes, my short strikes. Again, these are spreads. Spreads require two contracts. You're selling one, buying the other one. The one you're selling, you collect a higher premium than the other one you're buying. So because you're collecting a higher premium from the strike you're selling versus the one you're buying, that's a credit. The inverse would be a debit, but I'm not doing those debits for my day trading here. And again, the zero DTE, if you see here, it says zero DTE, and this yellow, meaning the zero DTE expires the same day when the market closes. And the time to the left of these is the time I enter the trade. And then here it says delta. To the left is the number. That's the delta of the short strike at that particular time. And to the far right is the strike of my, the number. So again, 15-minute candles. Monday, here, I went short, bearish, the first trade at 952, 0952. Okay, of course, it says zero DT. We know that same day expires. My short strike was the 450. And at that time, the delta was 37 delta. Real quick. The higher the delta is, the closer it is to the underlying. Again, I mentioned sometimes you hear me say the 16 delta. And I mentioned another delta. Standard deviations. That's on my other videos. So when I went short, we started to have a little gain. It went against me, popped up here. I closed the trade. Good money management. I was wrong. I licked my wounds. I closed my trade. Instead of being a sucker, staying in the trade, had more risk added to me, or being a worse sucker and adding to a losing position, Again, this is day trading, not marrying the position. So once I licked my wounds, I immediately went the other direction. I traded bullish. So I bought. I didn't buy it. I still did a bull put spread. Sorry. So this is a bull put spread, and that was a bear call spread. But like I said, I closed my bear call spread. I closed for a loss, and then I placed it on the other side, which was bull put spread. That was 10.05, and that was a 32 delta, which that moment, that 449 strike, the short strike, 449 was 32 delta. And I stayed in until expiration because the trend went up in my favor. So I made max profit when you stay into expiration. So again, shame on me, but I licked my wounds. Good money management got me out of it early, and say good mindset. Because some people would walk away and say it's done for the day. And I've done that sometimes. But again, I liked what I saw on the other side, and I took the other side of the trade, the bullish trade. So coming into Tuesday, look at that big trading range here again. I waited till 9:53, and when 9:53 broke out, I went long, bullish, 450 strike, 26 delta. So you see this yellow horizontal line. Typically my short strikes, for example, this one, because I was bullish, I want to have my short strike below the low of the day. So if there's a retracement anytime during the day, there's a lower probability, if it's still bullish for the day, a lower probability it's going to retest that low. I could be more aggressive and use higher deltas, like here, that was a higher delta, 37. So again, look here, this 10.05 one, when I placed at 10.05, my short strike was 449. That was below the low of the opening, the low of the day. And the low of the day was 449.8 cents. So my short strike was below there. So I'm reducing my risks. But again, I'm collecting less money. But good money management, I believe, I interpret. So here, I stayed in this trade to expiration. There it is, expired, winning trade. Max profit, staying to expiration is max profit. I don't do that all the time because I have a working order on as soon as get filled to close. But this one I let's stay in. Wednesday, a lot of volatility, So Wednesday, market opens 9:49. I went bullish. My strike was 455. That yellow horizontal line was, yeah, at that time, again, that was the low of the day up the opening, 449. And this delta was 36. Well, went up, had some gains, and look at that. Fast move down, went below my short strike. I typically close my trade when it touches my short strike. But it moves so fast. And then I stayed in it. Went up, retested the high. It just happened to be the high of the day when my order got closed. Thank goodness. Because the end of the day, in the afternoon, look at that, traded a lot around my short strike. Actually closed just above my short strike. So if I'd stayed in it, yeah, I would have made max gains. But the risk, again, this was a consolidation day, a lot of whipsaw, dangerous. You don't know till the day's end. So again, this one worked out fine on Monday, and Tuesday worked out fine, staying in for max profits. But again, I'm having a working order on first to close around 50%. And then as the market time goes on, I adjust it if I feel I want to. Either I cut it down to maybe 45 or 35% instead of closing at 50. And then this day, Thursday, yep, thank goodness I waited. So I went bearish, bear call spread. Yellow arrow is where I went short, bearish, and green arrows are where they close. Got it? So yellow arrows are where I enter, and green arrow is closing with profit versus red arrow closed here on loss. So Thursday, bearish, short, 10 o'clock, put my trade on. Delta was 46. Look at the strike. My short strike, 455. So it was slightly at the high of the day. Because again, these numbers for the strikes are $1 wide. 455, 456. So 456 wasn't playing enough for me to want to do that trade. So I went a little aggressive, high delta, 46. It was the minimum dollar amount I want to collect. And look at that. Impulse moved down real fast, sold off. my trade got closed because I already had a working order on to close at 50%, and it moved fast. So I'm glad it closed. What, within the first 2 15-minute candles? Good. I was done for that trade. And then, of course, if I stayed in at the end of the day, now in hindsight, you could say, yep, I could have made max credit. But look what happened there. It reversed and could have gone against me. So again, good money management helped me to not marry the trade. And coming in Friday was my worst one. I made profits, but it was bad. My entry was bad. Yep, I went short here, 956. Delta was 32 deltas. Short strike was 454. So I went short, went down, started to have some gains. Massive consolidation. I was suspicious. Popped up, went against me. I didn't like that. Of course not. I don't like that. And then it went down, finally got the trade closed. Again, when I went short, I got in early. Could have sat on hands, waited. If I waited, so down here, see these red candle, big wick on the bottom, green candle, big wick down there. Would have been better if I did a bull put spread down here with the low of this one, because the low of that was 453, that strike. 453, sorry, the low strike there was 452.21. So if I did the 452 strike, it never got tested today. Yeah. And you can do both sides too. And close one side earlier than not. But again, trade worked out. But this was not the best profit. It was a small little profit because I tightened it up. It was not 50%. It was almost break even. Made enough to cover commissions and a few extra pennies for coffee. Yeah. And we'll finish this off by looking at the 30-minute, 5 days, but each candle is a 30-minute bar. Again, here, Monday, the trend was up. But again, I went in short first. And then Tuesday, we got almost all green candles, nice. Wednesday. So you see Wednesday, huge consolidation. And same with Friday, huge consolidation. So Monday was a trending day. Even though there were smaller candles, it was a trending day. Tuesday was a trending day. Wednesday was a lot of chop. Some people call it consolidation. You can still make money in consolidations. Chop. And then Tuesday, that was trending down. And Wednesday, again, consolidation, chop, whatever you want to call it, but you can still make money. So that's the review. And I think it's important to do that once a week of all your trades you did for that week, if they're swing trades or day trades, to help better you for the next trades you make.